Welcome to episode number 38 of The Rent Roll, your podcast on all things rental housing, apartments, SFR, and BTR. And today's going to be a fun one. Joining me today in studio is the man, the myth, the legend, Mr. James Ray. If you don't already know that name, you may also know him by his alter ego, the voice and author behind many of those always trending CRE Analyst posts on social media, the famous account with 90,000 plus followers on LinkedIn. James is the co-founder of CRE Analyst and also managing director and a portfolio manager at MetLife, where he's focused on the rental housing space, among other things. So we're going to be chatting about some of his hot takes, why cap rates are BS, why the wall of maturities isn't the doomsday event that some think it will be. We're going to talk about buy versus build for BTR and for apartments, and why it's not as clear cut and simple as many investors think and imply right now. We're going to talk about institutional capital and their appetite for BTR, SFR, and for apartments right now. And then James is going to share some tips for emerging GPs trying to get in the door with institutional capital, spilling some secrets there. And you also get a chance to hear James's truly remarkable story. Here's a guy who grew up bouncing around trailer parks in rough neighborhoods and made his way onto Wall Street, now in a leadership role for one of the nation's preeminent institutional investors, and also spending time giving back through teaching and higher education, and also co-founding CRE Analyst along with his buddy Richard Bird to train up the next generation of analysts. And they've got an upcoming book coming out about commercial real estate valuations, and I was lucky enough to get an early copy, and I'd highly recommend it for anybody looking to better understand commercial real estate, whether you're a newbie trying to figure it all out or you're an old pro still trying to get sharper. Either one, I think you will enjoy it. And it's not like a traditional textbook. I think that's what's really interesting. It's real life. We all have seen the differences between sometimes academic research versus practitioner research, and textbooks are obviously no different. So this isn't your traditional textbook, and I think you'll enjoy it if you get your hands on it. Before we move along, I also got to confess something. James and I just recorded this conversation, and we went longer than planned. I typically try to keep these interviews around 30 minutes or less. I just think 30 minutes is a good length of time. Today's conversation went about an hour, but it's so meaty and substantial. And also James and I were just having so much fun nerding out over these hot button topics. He wears many hats, but as a fellow research nerd, we had a lot to talk about. And a lot of things I think are very relevant to multifamily SFR and BTR conversations right now. So I hope you enjoy it. Before we dive in, I want to give a big thanks to our sponsors. First, to JPI, a leading department developer with a stated purpose to transform building, enhance communities, and improve lives, working across Texas and Southern California, now Seattle and the Southeast as well. And also to Waymaker, a multifamily investment group focused on attainable housing and Class A apartments, partnering with best-in-class apartment builders across Texas and the Southeast. All right, as always, we kick it off with, here's a chart. And today's first chart is fresh data on apartment rents for the month of May. And we've actually got a little bit of a narrative shift and maybe something worth watching. There's been this long predicted rent rebound to be able to see this year. And we started off this calendar year on that track. The last couple of months, not so much. Okay, so we had, prior to these last couple of months, we had 6 consecutive months of improved momentum in the year-over-year effective rent change numbers nationally. We've now got 2 straight months of backtracking, meaning rents are still growing, but the pace of growth has moderated each of these last 2 months when you look at effective same-store rents. From in March, we were at 1.05% effective rent growth year-over-year. 2 months later, through May, we're at 0.74%, according to market analytics data, RealPage market analytics data. So it's not a big drop off, obviously, but it is lost momentum. And with 2 straight months that, I always kind of take 1 month, maybe a little bit of grain of salt, but 2 months starting to watch that a little more closely. And of course, that lost momentum corresponds with the start of the peak leasing season. So a couple of things I want to highlight from this. Number one, there really aren't any obvious reasons in the fundamentals data for rent momentum to have reversed. Macro demand is still very strong. I mean, just because you see just because you're not seeing this great leasing traffic right now, it doesn't mean there's not demand out there. Remember, we talk about this a lot. The demand number has been very good. The absorption number has been very good. It's just being spread across a great number of properties given the supply. That hasn't changed. That's been the case for 2 years. Vacancies holding steady in most markets, and it's actually pretty good in most of the country. Affordability is actually improving. Rent-to-income ratio has been trending down. I've been talking about that a lot. And so there's no obvious indicator for why rent growth momentum would be backtracking. Second thing, it's happening in markets of all types all across the country. It's not just a high supplied market story. It's most significant in higher supplied markets across the Sun Belt and the mountains. As you can see, for those of you watching this video, I have a second chart here that shows rent growth in the Sun Belt and mountain regions versus the Midwest and the coast. And certainly the rents that have already been falling in the higher supplied markets, and that depth of rent cuts had been moderating previously, and it's inched a little bit deeper these last couple of months, down around 2% currently. Again, not dramatic, but enough momentum shift to be worth watching. Also, what appears to be driving this is concessions in these markets among stabilized apartments, meaning non-lease ups that are utilizing concessions in the Sun Belt and mountain regions. The average discount increased from 8.9% of asking rent in March to 10.1% in May. So that's more than 1 month free on a 12-month lease. But again, it's not just those markets. I think that's what makes this interesting. Again, I always tell people, it's like if you see kind of one trend across, different markets, if you see like one trend in these higher supplied markets, like rent growth these past couple of years, it's fallen in the higher supplied markets. It's been steady in most of the rest of the country. That tells you it's all about supply. Right now, though, it's not just about supply, because we're seeing stalled momentum also across the coast and the Midwest, at least in this effective rent data, not in the other data, but at least in the rent data. So let me give you this list. Here's a list of markets, the most deceleration in rent change over the last 2 months. And by decelerate, I mean the change in rent change. So either rent growth lessened or rent cuts deepened. And that list is a mix of lower supply and higher supply markets. It's Las Vegas, Riverside, Baltimore, Austin, Memphis, Milwaukee, Kansas City, Washington, D.C., Denver, and Orlando. In all those places, rent growth momentum has decelerated by at least 100 bips over the last 2 months. Now, again, obviously rents are falling in Austin. They're still rising in Milwaukee. So we're not trying to say that all those places rents are falling. But again, momentum has dropped off in all of those places. So again, it's not just about supply. And so again, supply was the reason for these rent cuts these past couple of years. And yes, there's still a ton of active lease-ups competing for renters right now in certain markets. I think the year two hangover for lease-up projects is going to be a challenge. It's contributing to this. But when you see the same trend happening in lower supplied markets as well, again, it's telling us it's not just about supply anymore. So a great case in point, I think, is Washington, D.C. Okay. I think it's indicative of a broader trend here. This is my theory, at least. Obviously, DC has been a point of focus given DOGE cuts and federal layoffs, a lot of anxious headlines. But we've also heard from operators there, led by the REITs who operate there. And what they've been telling us is that the data so far has shown continued steady demand, healthy occupancy rates, healthy rent collections, improving affordability, meaning lower rent income ratios, all good signs. And yet, and by the way, also renewal rent growth, very solid. And yet, new lease rent growth, which is really what we're talking about. Whenever we talk about kind of headline rent growth, effective rent growth, we're talking about new leases and front door, people coming in the front door. New lease rent growth in DC is backtracking more than most of the country. Year-over-year rent growth eased from 3.45% in March to 2.35% in May. So that's a drop off, again, still positive, but momentum is off by about 110 bips over the last 2 months. And I think data like that, again, it's just emphasizing it's not just about supply anymore. There's something else going on. So what is it? I think it's about confidence, or I should say a lack of confidence. Consumer sentiment is low. We've all seen those headlines. And it seems industry sentiment is low as well. It was improving earlier this year. In these past couple of months with tariff headlines, increased fears of a recession, lots of negative news, DOGE, federal layoffs, et cetera. And again, while we've seen very high renewal demand, steady occupancy rates, you combine that with the fact that we're now in the leasing season, the leasing traffic numbers probably aren't showing the big pop that operators hope to see in the spring and early summer so far. And part of that's just the fact that we have so many people renewing their leases as opposed to moving. That's particularly happening, of course, in markets where all that demand is being spread across a greater number of properties, given new supply and prolonged leases. Meaning, like, in these higher supplied markets, they're used to seeing a big pop in the spring and summer leasing seasons. Maybe they expected to see that. And again, that demand is still being spread across a great number of properties, given the supply in the market, plus the fact that people are renewing their leases more often than not, more often than usual, I should say. So I think all of these things have probably created or combined to create a lack of confidence among apartment operators, some nervousness. And when operators are nervous, they're likely to sacrifice on rent to protect occupancy. And I think that's what might be happening right now. But we'll see how this plays out. But again, right now, I just think operators are nervous, and we have to see how the next few months play out. Either consumer sentiment translates to a weaker economy, which obviously softens demand, or we see, hey, this is kind of like the past blips that we saw in 2020, and again in 2022, early 2023, where demand softened a little bit. In this case, we're not even seeing demand soften yet, but in this case, it's rents. And then the kind of confidence comes back, and we see momentum again. So again, these next couple of months are going to be really critical, especially since we're in peak leasing season. All right, before I leave the here's a chart section, I want to highlight a couple more things quickly from, actually, I want to highlight a few more charts from REIT Week presentations for NAREIT's conference last week in New York. Again, this is a big conference of publicly traded REITs and their analysts and investors. I showed most of those slides in last week's podcast, but 3 of the apartment REITs hadn't yet released their charts at the time of the recording last week. So I wanted to quickly highlight some highlights, or quickly show some highlights, that echo some of these themes around strong renter financial health right now, despite these other things we're talking about related to rent. So let's start with Independence Realty Trust, IRT. IRT shows renter incomes ranging from 82 to 92,000 across their markets, with Dallas on top. Rent income ratios are below 21% in all of their key markets, except for Tampa and Denver, which are both at 24%. And then they're showing sub 19% rent income ratios in Oklahoma City and Memphis. So those are all good numbers. Again, remember, 30% and above when rent income is considered, rent burdened. And so we're way below that across all of the REITs, and IRT is no exception. Also, some fascinating data from IRT showing 52% of their residents are women, and that 22% of IRT's new residents are moving in from out of state. And for those of you who don't know, IRT is Sunbelt plus Midwest and Mountain West, but mostly growth markets. Another one on renter demographics, another REIT, I should say, CenterSpace, which is focused on the Midwest and Mountain West. CenterSpace shows surprisingly high renter incomes, even in tertiary markets like North Dakota and Omaha and Rochester, Minnesota. Year to date, new renter households have incomes of about $110,000 in their portfolio. And here's a really interesting one. Most of us probably don't know Rochester, Minnesota very well. In fact, most of us, if you're like me, think of Rochester, you're probably thinking about the one in New York, not the one in Minnesota. Well, in the Rochester metro area of Minnesota, renter incomes in CenterSpace's portfolio are coming in at $134,000 for new renter households signing leases. And so who would have guessed that, besides CenterSpace, of course, that apartment renters in Rochester, Minnesota are bringing in incomes north of $130,000. So again, interesting numbers that once again show strong financial health among renters in institutional grade apartments. And the same, of course, is happening in institutional SFR. And on rent income, 20.7% of income toward rent for CenterSpace. And then one more REIT, and it's a big one, Avalon Bay. AVB didn't release much data on their renters, but they did show a couple of very interesting slides on their development strategy. And here's an interesting one. I remember a few episodes ago, we talked about how apartment builders and home builders did not expect tariffs to have a major impact on construction costs. In fact, most were estimating low to mid-single digit impact. Why is that? Well, this Avalon Bay chart helps explain. I'm not going to dive into this great detail, but I just want to quickly explain this chart. If you want to know more about this topic, you can go find that past episode related to this topic. But just real quickly, I want to highlight this chart. Avalon Bay shows that materials represent only about 20% of construction costs. And that's the chunk that's really potentially impacted by tariffs. By comparison, labor and subcontractor profit represents about half that cost of construction. And so, as we talked about before, subs have increased capacity right now as far more jobs are finishing than starting. And so they're absorbing some of these cost increases, or they are cutting their profit margins in order to stay active and competitive. And that's helping reduce some of that cost burden as well for developers. One more slide from Avalon Bay for you before we move on. So I mentioned I'll be talking to James Ray in a bit about the math of building versus buying. And just for some background context, James talked about this. Most institutional investors on the private side, they typically want around the 200 bip spread for new development versus acquisitions in terms of yield. But this slide from Avalon Bay shows they're moving forward with spreads of 100 to 150 bips. And we know other REITs are doing similar. So, of course, we've talked about this a lot. REITs benefit from lower cost of capital. That helps. But also, they're long-term holders. Most REITs, of course, are long-term holders. And when you're a long-term holder and you're betting on this lower supplied future, I think it's maybe easier to justify that the development story. So I don't think they mind the spreads as much. But again, we'll get James's take on the buy versus build argument in a bit. But next up, rental housing trivia. All right, today's rental housing trivia question is brought to you by Foxen, a technology-first renters insurance compliance and rent reporting platform that helps you reduce risk and drive NOI. Check them out at foxen.com. And also go to foxen.com, that's FOXEN.com, because there you can register for a webinar I'll be doing with the Foxen team related to the NOI environment, how to improve yields, NOI a little bit in a tough environment. So that webcast is coming up later this month. So sign up there at foxen.com. So today's rental housing trivia question. MetLife built a sprawling apartment neighborhood with 110 red brick apartment buildings containing a combined 11,250 units in Manhattan in the 1940s. What is the name of that apartment complex? And of course, everybody who's lived or worked in New York will probably, you're already spitting out this answer, you already know. But this should be one of the easier questions we've asked, not even giving multiple choice. So again, we're asking that question out of honor of MetLife, the employer of today's interview guest. Next up, in the news. All right, just one headline this week for the sake of time, given the length of our interview, but this is from the Washington Post, and it says, these publicly funded homes for the poor cost $1.2 million each to build. And these are apartments, by the way, $1.2 million per unit. Subheadline, DC apartment buildings DC apartment buildings exemplify a national trend as the cost of affordable housing approach and sometimes exceed $1 million per unit in cities that also include San Francisco and Chicago. You probably put LA in there too. And here's the craziest part of this article. It's buried like halfway into the story. Quote, next door, the same developers built the Park Kennedy for mostly market rate tenants at a per unit cost of about $350,000, records show. So let's get this straight. $1.2 million per unit for affordable housing. Next door, market rate housing, $350,000 per unit. Why? Well, anybody who's in construction and development know this already. Red tape, costly strings attached, all those things drive up the cost of affordable housing. Qualifying for affordable housing subsidies often means taking on additional requirements and a longer approval process, and all of those things cost money. Oh, by the way, one more thing. For that $1.2 million per unit, you'd think that might include washers and dryers, but nope. Residents will still need to use a community laundromat, which is absolutely wild. $1.2 million per unit. All right, let's get back to today's trivia question. It was MetLife built a sprawling apartment neighborhood with 110 red brick apartment buildings containing a combined 11,250 units on the east side of Manhattan in the 1940s. What is the name of that apartment complex? All right, so all my New York friends are already shouting out the answer. Stuyvesant Town / Peter Cooper Village, aka Stuytown. And obviously that one has its own very unique story. You could Google if you want some of the story around that. It's certainly created some challenges over the years for various owners and whatnot, but that's a conversation for another day. Next up, thrilled to welcome in James Ray, a managing director and portfolio manager at MetLife, as well as the co-founder of CRE Analyst. We're going to cover a lot of ground, but again, I promise it's going to be worth your time. This is going to be fun. This segment is sponsored by the Guarantors, who offer a suite of insurance solutions designed to increase access for renters and strengthen risk mitigation for multifamily owner-operators. And a reminder, for those of you attending NEA Apartmentalize this week in Las Vegas, stop by and see the Guarantors at booth 639 at the Expo. All right, now we enter the interview portion of today's podcast, and I am absolutely honored to welcome in my friend James Ray. James, some of you know James as the managing director and portfolio manager at MetLife. Others of you know him as Professor James, adjunct professor at SMU, and a lot of you may know him as the co-founder of the wildly popular LinkedIn account and also training organization CRE Analyst. So, James, thank you so much for being here and making the trip up to Frisco, Texas.
I wouldn't miss it. I love being together in person. It's good to see you. I really appreciate you inviting me. It's awesome.
Yeah, it's good to see you. And so James, you and I have got to know each other a little bit over the years, through LinkedIn. Both of us have benefited from that platform. But in getting to know you, I've really just enjoyed hearing your story. So can you share a little bit about your story? First, just starting with how you got into commercial real estate.
Yeah, sure. Thanks for that. So it's kind of an interesting background because I feel like most people just sort of stumble into real estate. Most people outside of real estate don't typically know what the roles are. I mean, I think my mom still thinks I'm a realtor, which is fine. But I was probably a little rare in the sense I really did always knew I wanted to get into real estate in some sort. And so started off in architecture in college and changed majors 3 years into it, but still wanted to do something on the property side. And so went to grad school for real estate, graduated and got right into it and started in consulting, just underwriting models, building models, comparing financial analysis and really just valuing buildings. That's where I wanted to start. Always had an itch to sort of get on the ownership side of our business, but started by just grinding it out as a consultant 22 years ago, getting some reps. Which is what I talked to so many people earlier in their career just now about is how do you get those reps? It was easy when I graduated. You graduate grad school in 2005. It's really easy to get reps, right? When there's that many things going on, but that's how it started.
Yeah. Well, I've had this so many times on this podcast talking to people whose story nobody really thinks I want to be in commercial real estate multifamily, single family rentals, but you get into it, it sticks. So tell us a little about your career progression and ultimately how you ended up at MetLife.
Yeah. So 20 years ago, I was doing consulting and I wouldn't say I loved it, but I loved the reps I was getting. And it was interesting what happened. We were basically working around the clock. And there were some of us that worked on equity type due diligence assignments and some of us that worked on debt, primarily CMBS. I was out fishing for another job because I said, I'm going to go learn a little bit about our business, hopefully learn how to value properties for a couple of years and then try to get on the ownership side or at least a bigger brand that might be able to help me out long run. And one night, I remember this pretty vividly. I was talking to a peer of mine who was working on a transaction. They were underwriting it on the debt side for CMBS issuance. And the biggest deal at the time was Peter Cooper Stuyvesant Town, which is this giant multifamily project in Manhattan that MetLife actually built. Yeah, many decades ago. Yeah, exactly, in the 40s. Before you were born, yeah. A little before me, yeah, exactly. But so, and this deal was going, I think the sale price was like $5.5 billion or something like that, which is a massive deal. It's a massive deal now, is an especially massive deal 20 years ago. And the comment that was made is almost in passing because we're young. I mean, we're 24, 23 years old. And this person said, yeah, I think that Met might be carrying that at like $2 billion or something. I heard from a rating agency or something. And it was really done in passing. I think this is the kind of thing where the firm like buys you dinner, if you hang out past 8 o'clock. So we're all sitting around a conference table eating before we get back to work. And she said that, it just rang, that I kept coming back to that comment. Like, I don't know anything about anything. I barely know what a cap rate is, but the seller is carrying it at $2 billion and they're selling it for $5.5 billion. I'm interviewing for these other roles. I'm making X doing what I'm doing right now. And they're offering me X times 2 or 3 to do these esoteric things. Maybe it's pretty hot. Either it's really easy or this is a strange time. And so when I was interviewing with folks, and gets to the MetLife connection, when I was interviewing with folks, I would ask them questions because I'm from, as I'm sure we'll talk about, I'm from, pretty tough background. I had no safety net, right? So I literally could not get laid off, or I was going back to a trailer park in Southeast Texas, which was not going to happen.
Yeah.
I wasn't up there long enough to save any money before the world blew up. And so this is late 2006. And all these shops that I would talk to, I would ask them, basically, how do you guys actually make money? Mm-hmm. And what happens, in different environments when people aren't selling for multiples of what they're carrying, what they think the properties are worth. And so many of those people said, don't worry, that doesn't happen. Values don't go down. And today that sounds insane, right? Every time I tell someone that story, they laugh like that, but it's true. And that threw up all kinds of red flags. Well, through a connection of mine, a really meaningful mentor, Steve Barczyk, who was a professor of mine, I ended up teaching with him. I was a TA, still do a bunch of stuff with him. He helps out with CRE Analyst, and awesome guy. And he connected me with Met and said, look, trust me, I know you're young, you don't know anything, but these guys are big. They got a lot of irons in the fire. You should go talk with them. So went out to Jersey, talked to Met, and immediately I was like, all right, this is the kind of discussion I like to have, where you ask what happens if property values go down, and they say anything, but they never go down. They say, well, we know exactly what happens because we've been tracking it for 100 years and we've got the scars to prove it and a lot of wins and we've been around for a long time. We think through cycles, and it was just intellectually curious, and so that struck up a pretty interesting conversation, and it led to me starting out there in January of 2007. And
what's your role there now?
So I currently run the first closed-end equity fund that we've ever launched, I believe, on the equity side of real estate. So a $400 million low-density housing development fund. For the record, I'm not selling anything, don't offer investment advice, and all my opinions are my own and have nothing to do with my employer. But I'm really proud of what we built there. And if pretty much done most of the things that we do at Met in between starting in a risk and research job that literally there were 150 people in the organization at the time, and I don't think anybody wanted the job that I took. I loved that role. I loved being in research. I learned a ton, and then went to asset management, into acquisitions and development, and did that for roughly 10 years, and then launched this fund a couple of years ago. It's been pretty fun. Yeah,
that's awesome. So I want to get back to some of your story in a little bit, but let's talk about the avenue that many people probably watching this know you from, that is CRE Analyst. And some people listening, they probably just think of CRE Analyst as this awesome LinkedIn account with almost 90,000 followers. You're going to be laughing me pretty soon here with the growth pace you're on. No, you've got a great audience, a wide audience. I'm a little niche rental housing nerd, but tell us about the origin story of how CRE Analyst came about.
Yes, so a great question. I appreciate the kind words also. It's such a fascinating thing to me because this was just a passion project. So I've been teaching for a long time. So I told you I taught with Steve Barczyk at NYU, was his TA, took a pretty heavy-handed approach to that class. He really tried to train me how to teach and was kind of hard, right? He made me really learn this stuff. And it was a relatively difficult class that I helped him with, or a couple classes. And I think that stuck with me, but what's important is the entire time that I was going through my career, I was also teaching and involved with higher ed. And so you just see a bunch of things from that vantage point. And then when I moved to Dallas, I obviously stopped teaching at NYU. And then shortly after that, met the folks at SMU. They're doing some awesome stuff over there. Really proud of the work we do over there as well. But that is for a certain type of audience. And then there are other opportunities that people just didn't have. And so a buddy and I just said, man, I think there's a giant need for really engaging, difficult skills-based training. We talk about thinking versus processing is what we say 1,000 times. And we're trying to really create environments where people can be more thinking and less processing. We think processors are going to get paid less, frankly, and have a lot less autonomy. We did not foresee AI coming, but that really feeds right into that.
Sure.
So we just build these, what we think are some special classes. It's been a magnet for a lot of good people. And it's been incredible to be a part of.
And so real quick, I think people don't know this, like they see your postings, they don't realize like there's a real rigid, I wouldn't call it rigid, like a structured program that y'all offer.
I would call it rigid, actually.
Okay.
So we have like a boot camp thing, which is just and I'm not trying to sell our class, by the way. We actually try to talk people out of taking a class, believe it or not. I really do. That's something I get into about the difference between traditional higher ed and our approach, this little passion project that we started on the side. But essentially, Richard Bird and I started it. Richard's a developer, awesome guy, also has somewhat of a teaching background. We met knocking on doors, trying to get school board people elected, 15 years ago. He went back to grad school and got into real estate and has been a developer ever since, and has done really well, gotten into some really cool stuff. And we just get along, share a lot of key values. And we were talking about launching this class, and the class being our flagship class, we call it Fast Track, is really just the basics of our business, the 8 fundamentals of our business. And what we found is that rather than people breaking into the industry that take it, it's more about folks trying to level up. So the average age of our alumni is probably 32, 33. They're already doing really well in their jobs. They're one step removed from really calling the shots and really being trusted. And we work on that together, right? Which is pretty awesome. So we teach that class 3 times a year. And the rigid part of it is we cover these 8 fundamentals, and that's it. And we really want you to build skills on those 8 fundamental hands-on topics. We also have a valuation and Argus class, which is pretty awesome, and working on some other stuff, which is good. But LinkedIn is kind of interesting because probably the best litmus test, or we got all these great stats around our class. 98% of them say they love it. They would recommend a friend. The net promoter score is always in the 80s, sometimes in the 90s. Nice. People say they get $5 to $10 of value for every dollar they put into it. All that's really cool. But the stat I probably like the most is that compared to a higher ed situation, when class ends, everybody's done. Slam your books and run out. And all of our classes are virtual. And when we're all on Zoom in that fast track class on Wednesday evenings, people hang out for an hour after class sometimes. And usually they're the more senior people. Yeah. So we'll get into these off the record debates and conversations about stuff. And they're just so fulfilling. LinkedIn literally is just an extension of that. Yeah. So it's the stuff that we're talking about. We're applying the frameworks from class that we apply in what we call after hours. And we just said, why don't we just start talking about what we cover in class? And it really blew up during COVID.
And that's the best content. People ask me, I'm sure they ask you at the same time, same kind of questions. It's just like, hey, how do you get, interest on LinkedIn? It's just, it's not a formula. It's just finding stuff that you have conversations with people, you process it, you put some thoughts down on paper, you're curious about things. It's just scratching that itch.
I will say though, I don't know how you do it by yourself, because you can go so deep. I do love, we've talked about this a bunch, but I love that you tell the truth, like you were trying to get on what's actually happening there. I think that's why all of us kind of obsess over the stuff you post, because you can get into some really deep topics, which is awesome. It's got to be really hard to be a one-man band doing that, because at least we have a team of folks who teach, and we're constantly texting each other ideas. And so it's kind of, we have a list of ideas that
it probably just means you're better at delegating and being part of a team than me. I'm not trusting enough, probably.
Well, I love it. Keep going.
All right. So let's speaking of content, and you put out a lot of very honest content as well. And one of my favorite posts that you've put out was the cap rates are BS.
Yeah.
And this hit a nerve because a lot of people live and die by the cap rate. They think, I just posted. You and I both posted the other day about the EQR Atlanta deal. It's like, this cap rate's too low, right? Yeah. So I love your take on this. So how do you think about cap rates? And I guess follow-up question: how do you cut through the noise around it?
Yeah, and to level set, I don't remember who on our team's idea that was actually, but it was a good one, that concept. And I think that had to do with Blackstone buying ARC. And if you think back to a year and a half ago, some people were talking about apartment cap rates being 6, right? Yeah. So the byproduct of where investors are willing to buy assets, resulting in a cap rate of something like 6. Would be reasonable to some people. And they thought that's where we were headed, which is pretty catastrophic. If the average cap rate is 6 and lots of people just bought lots of properties at 3 something, you don't have to be a mathematician to get pretty concerned, right? Whether you're a lender or owner or whatever. Yeah. And we just sort of thought that was, first of all, BS. Like those levels were BS. And so we dug into it, right? And the nice thing about when you get something like a public company being purchased, like a big shop like Blackstone, with no inside information about either of those things and no position in either of them, you can sort of cut through it and say, guys, this is not about a cap rate, and it's not about like a 6 and And we think the cap rate on that, as we kind of put it into our framework and kick it around a little bit as a team, I think we came out in the high fours. And, then people scream about that's negative leverage. And we say, well, that's actually not true either. It's not really negative leverage. It may be negative income yield relative to the cost of your debt going in, but that's not negative leverage because you do get some growth, right? And you have to account for that. So our framework is really straightforward. We don't really believe in 3 approaches to value. Frankly, we think that the DCF approach is sacred, and we stick to that. And that really is all it was. You could pretty easily get to that cap rate by just saying, okay, we know what cost of capital these vehicles within Blackstone need, what they market and talk to people about. You start there, you figure out how much in-place income they have, how much juice they get from assumable debt. I think was a big part of that transaction. And then you can estimate what sort of growth that they're projecting because they were trying to renovate some units. It's not that hard, but you have to have the framework. If you're just slapping cap rates on things and you think that's how you value a property, in my honest opinion, that's wrong.
All right, so let's get real practical. Let's say that there's a deal you love. You're going to invest committee. The senior guys can push back, say that cap rate's too low.
Yeah.
What would you tell that guy who's trying to fight for that deal? And let's say you like everything.
Yeah.
Everything checks, right? Except for the cap rate.
Well, and I think the same thing happens on the development side, just with a different lens. But in that, and I get feedback from folks that teach with on our teaching team. There's in that exact same situation. My boss just really believes in a 200 basis point spread, to be able to develop something, or this cap rate's just way too low. And it's not really what I believe or don't believe. It really is just your perspective. And in that instance, it would matter, is that property stabilized or not? That's one big thing, right? And then it's all about growth. Right. So, I think that's why I don't know anything about EQR, why they bought this $500 million deal earlier this week. Other than what they put out. And the worst I can hear people say is that, maybe it's mildly accretive.
Yeah.
Right. And that's not that bad. That's a far cry from, negative leverage and doom loops and things like that. What I see is a group that has access to capital, looking to expand in a market where they have some operational efficiencies. And if I remember correctly, they do need to catch up a little bit because they were more concentrated in the coast historically. And this is a market they really like. And what they seem to be betting on is growth. So they're not buying in Atlanta because they're getting 4 yields. They're buying in Atlanta, it seems like, because they can get some growth and they have access to capital. And so just ignoring that seems naive, right?
Especially if you're not holding for 2 years, right?
Right. And our position really isn't to it. I'm not endorsing what anybody does. I'm not endorsing what I do. I told you it's not investment advice. But all we're trying to do through that account and our classes is to help people be able to understand why people do what they do. And so when we see something hit the news, well, we're immediately texting, like, what do you think they bought that at? And how much growth is inherent to that? And it's a much more constructive conversation than doom loops and and negative leverage.
No, I tell people all the time. That's what I love about what I do. I love about this industry is the groups have different strategies, different parts of the country, ABC, whatever, new construction, stabilized. You can be successful doing a lot of different things. You don't have to personally want to do that, but you can still respect, that'll work for them. And
it's humbling. Our space is very humbling. None of us have all the answers. There's plenty to go around. I hope everybody does well, and it's been helpful to kind of try to understand and always be measuring against your frameworks, but then realizing that no one has a monopoly on good ideas.
No, absolutely. Whether you're institutional or mom and pop in a small tertiary market in the Midwest, you can be successful. Yeah, totally. So let's talk a little more about pricing, bigger picture. We talked a little about multifamily just now, but how do you've looked at all these sectors. How do you think about multifamily relative to scattered SFR and relative to BTR, where it is today, where it's going relative to alternatives, big picture?
I'm always careful about where we're headed on stuff. One, because I can't make comments like that, but two, I really don't know. I talk about being humbled. If you really try to guess about where
none of us know.
You don't know. But what I do try to latch onto is people who I like their frameworks, and they apply these frameworks. And one that I think, I'll give you a framework I think makes a lot of sense, and one I think doesn't make much sense. The framework of, hey, you've got a lot of income-oriented capital out there that's longer and tenor and liking residential product. That seems to me to be, I wouldn't say insatiable, I wouldn't say limitless, but I would say a very deep pocket of capital that if yields fall to a certain level, it's certainly there ready to go. And people talk a lot about dry powder. I think you have to disaggregate that. That gives me a lot of confidence then in assets that that type of capital, and there's a range within that box of capital, it gives me confidence that that capital is there, right, at a certain price point. That framework makes sense to me, and it gets right back to the DCF stuff we were just talking about. The framework that doesn't make as much sense is and this is just making sense of like trying to project values, right? There's just a lot more uncertainty around if you weren't feeding into those boxes of capital, and you were trying to move. So let's say specifically you were buying a Class C apartment property in Phoenix and renovating it lightly and pushing the rents by, $300, $400, $500 a unit or something with light renovations, or even not, and you were just riding the cap rate wave and leveraging it up with floating rate debt. That is an approach that a lot of people got really wealthy on and generated a lot of value in a short period of time. But it's not income oriented. And so, but it started pricing like that, right? So those deals got into the 3s and 4s. And, folks that have been on your podcast have talked about, maybe those operating expense ratios weren't super accurate. Maybe those credit loss rates weren't what's going to be their long run. In short, I think those income oriented properties that folks like EQ are buying, it's hard to see those values falling because that capital's there. If anything, it's probably going to run with growth. So as growth picks up, you think that they run with that. And if things settle in, like spreads come in a little more, I could see a move there that would reasonably fit in our framework. But if you were playing the game of, I'm trying to convince people that these non-income related deals feel like income related and getting folks to buy them at 3 and 4 caps, that's tough. I mean, I don't know where it's just wildly uncertain where those values are.
Yeah, we still have to see bigger spreads than we do now.
It's just an absolute guess. And nothing would surprise me. Maybe there's a bunch of family office capital that just likes that. They love places in their community. They want more exposure. I could see that. But I can't see it directly through one of those frameworks. I think the way that I answer that question is one of those paths, I would break the housing space into just halves. And it's probably more like 60, 60-40, 70-30. On the bigger chunk are these income related assets. They're in reasonably good shape and they're predictable and you can leverage the underlying economy to get some growth. Those things, it's hard to see. You can kind of see where those values are headed probably. The other product is wildly volatile to the upside over the last 5-10 years, and it's got to shake out some, right? There's so much uncertainty there. And so that's just the way I think about it. And it resonates. I'm not the only one that thinks that way. I mean, He talks about that. You talk about that. Several of your guests have had similar take. It's not an original take, but
no, I'm of the view. I think somebody's eventually do really well on those lower quality assets, but they're going to it's going to be a big bet. It's not a slam dunk, and it's a timing play.
Yeah.
It's and I don't think we're there yet on the spreads.
It is super interesting though when you look within those income buckets, like core funds, core plus funds, sovereigns, folks who are really long-term investors and looking to income. There's only so much space that they can go, right? And so you see that they do move markets. So if you want to get out of office, where are you going to go? Data centers are actually pretty small.
Yeah.
And so just that one decision, I want out of office, is going to meaningfully affect housing markets.
There he is.
The capital has to come there, right? Which is part of why I think you get so much attention on alternatives. And that's happening, not just because people are trying to get out of office, but we certainly see that, right? Where those income investors want to expand there. And I think for a long time it was multifamily and industrial, and it doesn't have to be either or, but I don't see that attention going away either. It's just a bedrock of these portfolios.
Any thoughts on SFR and BTR relative to multifamily?
I mean, super interesting to me, just pricing today, right? Public, private, get a 15 to 20% delta. SFR BTR, I think it's really fascinating when you look at, where those values have traded over the last few years. I think the deeper capital buckets in multifamily were sort of more aggressive in their pricing by the tune of maybe 25 to 50 basis points of the cap rate. And then it actually kind of went the other way for a minute. And then now I feel like it's probably back to that. If you polled the big brokers, investment sales folks, I think they would probably say that the 25 basis points-ish difference. What's interesting to me is just as you ride that curve, where individual assets are, which I just think our markets are incredibly efficient over long periods of time, but they can be incredibly inefficient in short periods of time.
Yeah.
So much is just about the capital and what they're trying to do. But I think the bad news around all of this is I just don't see pockets of distress that create these wide pricing differences. That doesn't mean they don't exist. I just don't see them.
Yeah, absolutely. So you mentioned the discount for public REITs relative to private market values. There's a lot, certain groups, I won't name names, make a really big deal about that metric.
Yeah.
Does that really matter? How do you think about it? I mean, what is it?
I definitely think it matters, but maybe for reasons that are different than the headline reason. So you think about the names that we've been talking about, a big buyer steps in. What I notice is that buyers in today's market of those income products have one of two things. They're either insurance company backed. So you think about pretty much the only player out there buying scattered stuff right now is insurance company backed. And then it's public equity with access to debt.
Yeah.
And so if you trade at a big discount, that cost of capital shifts pretty meaningfully, which pushes you to the sideline. And so to me, that's why I think that discount matters.
Well, that's a good point. Yeah.
That's why I track it, is because I want, and coming from someone who spends a lot of time developing assets, investing in developments, I care a lot about who my buyers are, and so I really like that capital coming into our space. I think it's healthy for all of us, but that's why I care about the delta. I definitely think the delta matters. I think the CEOs and CFOs.
Oh yeah, I agree on that point. I guess let me rephrase my question. So what about, do you think a pricing index is more accurate based on what REITs are trading at, or based on like a RCA, MSEI, property price index, Green Street's property price index?
It's probably such a lame answer, but I want to know all of them.
Yeah.
And my favorite thing about our space is it's inherently dark in the sense of it's inefficient, in the sense of, even though I say the capital's pretty efficient compared to other asset classes, our transactions, they're not structured intently to keep people out, but unless you're involved in the transaction, you don't know. Right? Yeah. So we're all guessing, and some people can make much more educated guesses than others. And so I love that about our business, right? Yeah. And so I want to know all of them.
More data points is better.
Yeah. And so I think both of them are valuable. I think I kind of bucket valuation indexes. We actually are writing a textbook on valuation. I'm happy to share that article.
Oh, nice.
Because there's one on these indexes, but I kind of bucket them into three groups. There's the transaction-based indexes. And, I would talk to Jim Costello or someone at MSEI because they could explain it much better than I can, but they are really sacred around the way that they track transactions. That's great because it's real. We know that something traded. Then there's the other side of the coin, which is I'm just guessing what would trade if it traded today. So that'd be more like Green Street, CPPI. My word's not theirs, but I consider that to be more of like a BOV, right? Yeah. And then you can get indexes that are sort of tweeners, where it's estimate, but it's not based as much on like pure feedback. And I would say a public stock market index is something like that. I care about all three. I think they all three say something really meaningful about what's going on.
I just can't imagine, like, for my friends in the probably trade REIT business, like when your value you can move every day based on things that have nothing to do with your industry or how you're doing. Like
it's super. And think about it, if you're a sponsor, and as sponsors are really sophisticated, right? So you got a great deal and you've got a great term sheet. There's always strengths and weaknesses of those term sheets, and they're really sophisticated about looking through to what you're putting in the term sheet to tell me where this money's coming from, and I admire them for doing that. That's what they should do.
Yeah. All right. So we just tackled a hot topic, pricing and cap rates. Cap rates are BS. The big takeaway there. I love it. Another hot take that you've had in your posts are about the wall of maturities, and you and I have a shared affinity for this one. So, the perennial headline, of course, is that there's this ominous wall of maturities around the corner, and it's going to, destroy everybody. So give us your take. How big is that wall, and how big of a problem really is it?
Yeah. And again, just my personal opinion, but it's the opinion generally of our team as we're kind of kicking things around. And so it is something that gravitates to the top when we're talking about posts. And it's just this idea that, oh my gosh, there's this massive wall of maturities, which comes up every time there's a recession. And is very natural because loans are in our space 3 to 10 years. The 3-year loans tend to be on less stabilized properties. You get tighter debt service coverage ratios often in there, and then so therefore you have natural preliminary extensions or preliminary maturities, and so you chart that out and it looks really scary. It's really easy to write kind of a piece that'll get a lot of attention on that because it's scary. You see that and you're like, oh my gosh, everybody knows maturities matter. So if that's the case and we've got a lot of maturities next year, then stuff's going to hit the fan. It's just that hasn't happened historically that way for a bunch of different reasons. And that's my short take on it, is it's really important to know those bunch of different reasons. So one of the groups that I really respect a lot is the way that JP Morgan talks about this. And I haven't even talked to them about, mentioning this, but they do a good job in all their research. I mean, whether you're talking to REIT folks or their their fixed income folks on the CMBS side, they generally talk about maturities as first maturities or fully extended. They're just, the charts aren't as sexy. You know what I mean? And so that, to me, that's what half of it is either someone's moving really quickly or they just really don't want the nuance, and that's okay. Everybody has reasons for telling their stories, but to me, I really want to understand what's going on and what happens with those wall of maturities. A great example is someone on our team came up with this idea to do a little case study on Willis Tower a couple years ago during its initial maturity. And it was one of the biggest maturities. And when the hype about the wall of maturities causing a banking crisis, blah, 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 was dominating headlines, we looked at it, kicked it around, and all of us agreed. We're like, this thing's going to get extended.
Yeah.
You know, what else could happen? And then that's exactly what's happened a couple times. And I think they got a longer term extension. That's a SASB loan. So it's a little interesting there, but it's giant. Everybody knows the Sears Tower. So it got a lot of attention, and it just pays to kind of disaggregate and dive into what's actually going on. And bottom up, we just see a lot of these deals that seems like it makes sense for everybody to just kick the can.
Yeah.
As much as none of us want to hear that, it's just what's happening, you know?
Yeah. Well, like you said, the chart doesn't look as sexy, but, you know, I was joking with you earlier that I used to have in my presentations that I give, like, you know, these headlines showing wall of maturities, and I would hide the date, and you could go back every year, going back, you know, forever.
Right.
It's the same headline.
Right.
It's just a different, you know.
It also helps that values go up. Therefore, the amount of debt that you put out goes up, you know, and then if you take 3 to 10 year loans, then you just naturally are going to have those
push back.
Yeah, exactly.
Yeah. That's just the nature of it. All right. So, let's talk about development a little bit. You know, one challenge for developers having right now is this perception that their investors, they're saying they think they can buy cheaper than they can build. And, you know, personally, you know, my personal view on this, when I ask your opinion on this as well, is that I think that's often proving to be more true in theory than in reality, meaning like there's just not enough volume out there to really buy and achieve any scale to deploy, you know, especially if you want well-located, you know, Class A, newer vintage, you know, multifamily and BTR. So maybe development is a more scalable path. But how do you think about buy versus build for BTR and apartments right now?
Yes, I've seen a bunch out there, right? And I try to stay super engaged in what's going on. And I will say I have seen some people buy things below replacement cost, and I'm like, man, that seems like a good deal.
Yeah.
You know, and they had some kind of edge, which I think is an interesting topic, but that seems definitely more atypical.
Yeah.
What I'll also see is someone fishing for equity that says I can buy this at below replacement cost, but it sometimes is because it shouldn't have been built there, you know? So that's you can buy it below replacement cost, but if you overbuilt it, that's a problem, right? And so because your rents aren't going to justify that. And I think you have seen that a little bit, but there have been success stories there in hindsight over the last few years.
Sure.
Just so few. You know, like, I mean, I probably know a dozen of them. Right?
Yeah.
And then,
it's not like you just spin up a fund and just go do it.
Yeah.
Right?
And then on the development side, it's tough because I feel like the way a lot of people, the people that I dive into and talk to is like, hey, why don't you like development? It generally is because I want a 200 basis point spread, let's say, over market cap rates, which are a 6. So if you take the whole cap rates or BS, you know, thing, and you say that you thought that 6 was the market cap rate, I need to build to an 8. To me, that just says you're probably not interested in developing, which is fine. And I get that you think that you need to get paid for that amount of risk. But there are only a couple different levers you can pull to make that story different. And it's possible that with the benefit in hindsight, in a couple of years, you may look back and say, I was too conservative with that 6.
Yeah.
Or I was too conservative with the 200 basis points. That probably has a lot to do with where you're trying to build.
Yeah.
Right. If you're trying to build on the periphery somewhere, that probably is pretty good math. But if you've got a really great site or a different project, we do see trades in the mid to high 4s right now. I know that flies in the face of some narratives, but I mean, those are well documented. Ask any broker that's really in the market. And I think that's what they would tell you they're seeing. So again, it may be the case. And in hindsight, you look back in a couple of years and you say, gosh, that 200 was too wide and 6 was a joke, or 5.5 is a joke, right? So if you're trying to get to mid 7s, it just depends on the project though. Some projects are a heck of a lot easier to build than others. There's a lot more risk in some than others. And then now you've got cost uncertainty. And that I could totally see that pushing people back into acquisitions, which by the way is great for the market.
Yeah.
So in general, I tend to really get more excited when capital is flowing into all of those. You know, you don't want land prices cratering. You don't want land prices getting too excited. You don't want asset prices, going too far in either direction, but it stays stable when you got capital flowing in all directions. So I could see why those arguments make sense, but they're probably more situational.
Yeah, and especially where I've seen, you can tell me if I'm wrong here, where I've seen the really big discounts to buy versus build are oftentimes these urban high-rise sites. Yeah. There's been some big ones in the news in Los Angeles and elsewhere.
Yeah.
Where very little new is going to be starting under construction for a long time.
Yeah, I've seen two places. The big high-rise deals that were especially larger units.
Yeah.
Right, where you just have really big rents that are just tough to sell with renters by choice who probably have moved. A lot of those people have sort of moved with household formations. So I've seen some of that, a couple dozen projects maybe that are like that. I've also seen relatively dense product, whether that be townhouse or horizontal multifamily. This is really far out.
Yeah.
Right. So I've seen some of those deals come up as well, where you can definitely argue they're below replacement costs. I mean, then the other part of replacement costs is it below your replacement costs or is it below today?
Yeah.
Because it's super inflated, right? So then you're almost always below replacement costs. Those are the only two types that I've seen. And people that make it work, they're sort of finding the needle in the haystack, that this actually could have been built, or maybe it was built 2 years too soon, but rents are growing in a good way. And I've known some folks that have done quite well with that. Same way with the high-rise product. What I've seen there is maybe it was built sort of, the amenities might be a little below, and someone's coming in an efficient way. And then weirdly, the folks can come in and recapitalize it a little bit and give it a little spruce up. And then you get some activity because you probably still are drafting behind the other high rise that's, more fully leased. So you got a value proposition. That's really the only place I've seen that.
Yeah. So let me ask you another kind of big picture question, one that I know is hot on the minds of a lot of folks who are listening right now. And that is the state of, or the appetite among institutional capital right now for apartments, SFR, and BTR, because it seems that the general sentiment is everybody likes these sectors, but there's a lot of kind of wait and see or just not yet.
Yeah.
What's your pulse? What's your read on?
I mean, that's a really good question. I feel like it gets back to what we were talking about earlier. I feel like income-oriented investors really want to be in housing.
Yeah.
Full stop. And part of the issue is that we, transaction amounts or the number of deals that are trading is still relatively low. It obviously doesn't help that interest rates are pretty elevated. But even with that, you see the same stuff I do. I'm just always in the middle of the night flipping through decks that I can catch on some pension fund's website. And almost every single operator sponsor is proud to have access and some engine that generates deal flow into housing.
Yeah.
Right? And I think they're responding to capital. I haven't seen people talking about lower allocations to housing. NCREIF added SFR to their index, right? The set of indexes. I think that's a pretty good indicator of where things are going. Anytime something's nascent, you'll find, it's moving around a curve and can be a little volatile in the way people track it or find opportunities. But I don't, just my guess is and really my observation is I've not seen any backing up on that. It's just more the short-term economics. And you're starting to see capital come off the sidelines, particularly in those income-oriented strategies like Core Plus. Like I've read about probably a half a dozen, 9-figure commitments in core and Core Plus type mandates and fund formats. A huge percentage that's going to go into housing, right? Kind of has to. And so that's leading that charge. Same thing with the NCREIF index turned positive late last year. That's massive, right? So those are both prereqs to getting back in the game. You don't see people talking about lower allocations to housing for the most part.
You just brought up another hot topic in my mind is core and core plus, like these definitions. Yeah. Let's think about in the housing world, like, these are well entrenched terms, but if you had just paint a picture of what this looks like.
Yeah.
Like what is it?
Yeah. So it's funny because this is what we talked about in our very first class, which is buildings aren't lines on a spreadsheet.
Yeah.
You really have to understand that what differentiates buildings is that they're physical. So for better or worse, they're just like us.
Yeah.
We get old, we get more gray hair, like, or less hair, or, you get around a lot slower. The same thing happens with buildings and you have to recapitalize them. You also can just get a curveball with tenancy, right? So and then now you're maybe less attractive than you were 20 years ago when you were brand new. And so you really have to do something different. And so we think about it like a clock, like you start at the base. So call it 6 o'clock and you're worth land, and you really have no income. It's going to take some sort of meaningful injection of capital and a business plan to lock up some leases. You get it to the top of that clock and you can kind of hang out at noon or midnight for a while. Once you maximize the value of that building, and then it's all about trying to stay at the top of that clock. So everything on sort of that side of the clock we would call core, right? So income oriented. As you start slipping down the side of that clock, if you will, toward 3 o'clock, that's kind of core plus maybe. So you lose a big tenant, you recapitalize it, you come back. If you're outside of multi or SFR, or you have to redo the amenities or something, that would be that. Or you're just borrowing more. I mean, that the only other way to take on more risk is to borrow more. So you could have a core strategy with a lot more debt. So it's core plus. And then as you fall down the side of that clock, I think that's where you get to more value add and opportunistic. And now you're back to square one. And so that's the way I think about it. But I do think your point's a really good one, which is what are those boxes? And I kind of think about them more like puddles.
What about in terms of geography? Because there was a day not too long ago where core meant you had to be in the sexy six markets. Yeah. Now that's not. I mean, you could be suburban Dallas in your core.
It definitely evolves, right? The way I think about it is you want core to me means pretty specifically. It used to mean purely institutional. I don't think it means that anymore, particularly with all the retail dollars coming in. I mean, you see that already, right? You get these huge pockets of money that they care less about. I mean, I'm just picking these markets from out of thin air, but they like Knoxville just as much as they like Austin, right? Or Dallas. So that I would argue that maybe you have some core capital there, but you definitely see the research I've done and I've benefited from seeing from others is in the top 15 markets, it's a lot easier to get that income oriented capital. Yeah. They're very skittish about getting.
So outside. It's gone from 6 to call it 15.
Yeah, that's right. Yeah.
I like that.
I do think that's fascinating to see how, ULI puts out good stuff on this every year. I think it's fascinating to see how market focus shifts.
Yeah.
And, we've been through a couple cycles now. It's just so fascinating to me. Everybody gets their day and everybody gets their turn in the barrel. And which I think is important to keep in mind because when you're in the barrel, it's going to get better. And when it's your day, don't get too cocky, because it comes from.
I call it the SI cover curse because you see
Madden curse.
The Madden curse. Because I remember Houston was the number one market, and then oil prices, 2015, whatever that.
16 something.
Yeah. So you want to be like 2.
And it was Austin, and then it really, and now it's probably the Midwest, and probably some Texas cities and. It's really wild. And you see New York, San Francisco also get up there and then they fall. I mean, everybody gets their turn in the barrel.
Absolutely. All right. So another question on institutional appetite is that there's been so much focus now on the shift from equity to debt.
Yeah.
Issuing private credit, having debt funds. And the sentiment today I hear a lot, kind of anecdotally, is that it's gotten so much easier to find debt. It's hard to find equity. Yeah. And so what would cause that to change and what's going to get equity more available again?
I mean, this one thing I really love about markets is they balance each other out and we're all connected.
Yeah.
Right. So it's literally impossible to have debt without equity.
Right.
So if you're 50% levered, for every dollar of debt, there's a dollar of equity. So now it's harder to raise equity. It might be more expensive. But you have to have equity to borrow. And I think that self-governing, it's almost like a sailboat. If you get going too fast on a sailboat and it heels over, it's going to slow itself down, which is part of the reason they don't flip over, right? And so that the same thing happens in our markets. So, you talk about this literally better than anybody else I know. If supply evens out our markets, I generally think that 3 things sort of rock the real estate world, and it's too much supply, too much debt, or interest rate spikes. Unfortunately, we've experienced a third of those, the last few years, but the last third, or the last one of those shocks, but all of those sort of level each other out. And all we're seeing right now is investors say, well, why would I invest in equity? If you take a big operator that's done a bunch of non-core funds, a good track record might be 15 net to investors or something. Talking pretty high octane stuff, but you're doing a lot of it. Or if I could get a loan at 8% and leverage it up with 4% debt somehow, and I can get a 12, that's just tough math for people, right? Now, I think it's always important to remember that no strategy is perfect, but it's also important that we all kind of had those clocks that I was talking about, around, everybody gets their day and everybody gets a turn the barrel. So private credit's certainly getting a wave. I don't think that money goes away for what it's worth. I just think you're probably seeing more of a shift because banking is huge.
Yeah.
It's really important to break down real estate capital is not monolithic, as you know, right? So there are 5 different kinds of lenders as we think about it. And one of them dominates, particularly on the short-term product and construction loans, which is banks. And they've been less active, and they've certainly come back strong in the last couple of months, but it wouldn't surprise me at all if private capital in our space goes from 5% to 10%. It's a little harder for them to gain market share because they're all short-term, most of them. That's a big move.
Yeah.
To go from 5% to 10 is a really big, I mean, those are tens of billions, hundreds of billions of dollars potentially. So I don't look at it as much either or, but I do think you get these pockets where one gets very much in favor and one gets out of favor, and yield matters a lot to balance that out.
Yeah. So let me ask you a follow-up question to that then. So in the hunt for equity, you have a lot of groups out there that are trying to get in. They're trying to get in with institutions. And institutions are some of the groups that have a lot of dry powder out there. There's a lot of people knocking on their doors. What advice would you give groups that are trying to form partnerships with some institutional capital?
I mean, honestly, I try not to give too much advice because but I will give you the advice I give myself, which is parallel. Develop an edge and a skill set and double down on it. Invest in yourself. And so my example is I try to be a really good capital partner. So for sponsors. So if you flip the question around, get to what makes a good sponsor, what makes a good capital partner, be a really good capital partner. What does that mean? It doesn't necessarily mean you have to give things away. In fact, it probably means you don't, that it's more of a trusting relationship that you're building up over a long period of time. But what it does mean, and I see this the way I try to differentiate myself and what I do is, for example, if a sponsor of mine crushes it, they do something really good on a deal, I'm not going to berate them for making money because they get a promote that's different than mine. I'm actually going to celebrate it, and I want them to get paid really fast. For some reason, I think some capital partners have a hard time with that. I'm glad they have a hard time with it because I don't. As long as I negotiated the structure and I feel good about it and it was market and everything was done above board, I think it's good to celebrate that. Similarly, if we're going through tough times, sometimes you have to have hard conversations. I think you can only do that around trust and to do it not in a I'm bigger or more powerful way, kind of berating folks, shockingly, tends to work a lot better. When you try to work together. I do think that helps though. I've got decades left in my career. I don't, if it's the last deal that you're doing, maybe people have a different take, but then you could flip that back to the sponsor. Then how do you differentiate and attract capital? Even though I said earlier that I believe in our market being efficient generally, but inefficient at times, I think it's actually really, really efficient when you come to this. So meaning if you're really good at what you do and you create value, people know. You're not just going to find an amazing partner hiding under a rock that no one knew about any more than you're going to find $100 million that's just looking to invest in your deal under a rock. I think networking is so important in our business, but I do think it probably gets a little too much credit because in the sense of it's not networking in my experience that finds you that partner or finds you that money. It's having an edge. Now, it's not black or white. You kind of have to have both. You have to have exposure. You can't deliberately hide under that rock. That's my take, is get really, really good at something. And it is hard. Yeah. I talked to so many early-ish career people who want to start their own things. We're all autonomous. All of us kind of want to do our own thing. We love autonomy. Gosh, there are a lot of sponsors out there. Yeah. There are a lot. I mean, I would point to this. There are a lot of podcasters out there. This is a different podcast. You do it differently, which is why I think you've carved out a spot because you have a little edge, and it's true. And you can do the same thing as a sponsor. You can do the same thing as a capital partner, but it just doesn't happen randomly. So maybe that's a boring answer, but that's what I would say. Try to double down on it.
Yeah. Find your identity. Yeah. It's true for anything. Another question on markets is just as you're thinking about institutions and the groups out there, what's the view among institutions right now on the differences between, or the appetite for apartments versus BTR versus scattered SFR right now?
Yeah. So fascinating how those markets have evolved because both have been born basically over the last 15 years from an institutional standpoint, and they've had ups and downs already. This is just more of an informal survey, talking to peers and people that invest in it. The common approach or common feedback that I get is that big investors want to be in all of it.
Yeah.
They're not, they are in the space because it's a structural thing, not because it was an overnight thing. And sometimes economics look better in one than the other, but you got to be careful playing that. What they're really trying to do is anchor into the demographic growth, and the capital growth that follows it. That's not so fickle that it has to be one or the other. And in fact, they really interact with each other.
Yeah.
I'm talking about purpose-built rentals versus scattered product. They tend to interact quite a bit, and increasingly investors are in all, you know, and and increasingly they're just living sectors, right?
Yeah.
So it's everything from multifamily to scattered. And frankly, I've found, I think where we might be headed as an industry is these mixed density communities, right? Which aren't scattered in the sense that you have houses that are separated and you need the managers. We'll always need those managers, I think, to manage scattered product. But I think the 25 core funds that are probably going to buy more of this product going forward, I think they're going to like these mixed density projects that has, you know, a townhome, an apartment, and a more of a detached type product that was built for renter all in one community that a big manager can manage. Right?
Yeah.
They're going to like that when they see it, especially when it gets in a good location. And we seem to be heading in that direction. I don't think it's either or. There's only one sort of magic trick, but that's one that I could see coming about. And it's a great example because it's all the above.
I agree with you. I think our industry, we're so focused on, you know, comps, comparisons, like this or that, you know, for sale or for rent, SFR or multifamily. And the truth is, like, you know, most of the time they're all dependent on the same broad tailwinds.
We're also super competitive, right? So I want it to be my way. You want it to be your way. Where in reality, it's like so many of these are just custom tailored things. I think it's just incredible to be in our space right now as these products are coming around and there's so much capital appetite. I mean, I think some really good things are going to happen over the next several decades, really, as this continues to blossom. You know, there'll be all kinds of opportunities.
Absolutely. I agree. All right. So, James, we alluded to this earlier. I want to come back to this. And I think now that we're, you know, at the tail end of this podcast, people have picked up on the fact that you've got a lot of passion. For real estate, for housing, for data, for training, for teaching, and for doing it in a way that's not, you know, self-serving, but in a way that's uplifting to others.
Yeah, thank you. Yeah.
What's the foundation? What drives you? What fuels that passion you have?
Yeah, I appreciate you asking that. Because I don't talk about that very openly, but I do think it takes about like 5 minutes to just realize I have this like a different gear. You know, I the older I get, the more I realize that, and I respect people who are I don't want to say more measured, but I guess it is more measured in some cases. But as an investor, I'm really measured. As a researcher, I'm very measured. But there's something about just like energy and passion. And I think if you really rip everything away, it primarily comes from truly believing I'm extremely lucky. So a lot of people say that I'm so blessed thing, right? But and I get that. But for me, it means like the likelihood of me working in an industry where my peers are regularly making millions of dollars a year, working with people that they generally like in communities that they enjoy and they feel connected to, the likelihood of me being even in that sort of stream was literally zero. Not like, and that's not an exaggeration. It wasn't 0.000, obviously, but it rounded to zero because I grew up in a really tough environment, you know, and I don't wear that as a badge of honor, but it's true. And I do think that is super motivating. So to me, that meant moving around a lot. Pre-junior high, probably went to 10 different schools in 7 or 8 years. My mom was, you know, she struggled with drugs and alcohol, unfortunately. Great mom in the sense that she loved me to death, but, you know, struggled and still does, unfortunately. But that has a huge impact on the way you grow up. And it's kind of nice to be in a suburban classroom with people that look like you and speak your language. And it's similarly nice to be kind of the only white kid in the neighborhood that you don't act like you own the place because you don't, you know, and you get some bad breaks along the way, or we did, where, you know, you get your utilities cut off pretty frequently, moving around, living in pretty tough environments. And then was lucky enough to move to a little town in Southeast Texas where it felt like home. People down there didn't really care about that. So that was huge to have a lot of instability, then to go to some stability. But then I started looking around like, I have an extra gear, like I want to do something, you know, and it is so hard for people that have that gear to learn what's going on, particularly in a community like ours, which operates not in the dark, like there are no lights, but no one's advertising like, here's what's going on in this conference room. Here's what we're talking about. You kind of have to know that it's there. And I think that really is a big part of why I care so much about spending my free time teaching. You know, when most people are sleeping, I'm, like I said, searching through pages of documents. And so much of it is just that our industry is so unique and people don't talk about it a ton. And I love the idea of creating inroads into that. You know, I mean, I didn't mention this earlier, but what actually triggered Richard and I to start CRE Analyst is probably the best example. We had talked about it. We knew there was a need. But then we met these two guys, Reggie and Derek, and both of them were software salesmen at the time. Real quick story, but it's meaningful. And they basically, Richard and I met them for breakfast, and they're like, hey, listen, I'm an ex-athlete. I know that I want to get into real estate, but I don't know how. I can't add skills, and people say they like me and they think I could be good if I could just add some skills. And, but I don't know how to get them.
Yeah.
I'm not going back to business school for whatever set of reasons. And even if I did, I'm not sure that would get me what I want. And so, you know, we heard that you guys are thinking about this. What is that? And, we didn't, to this day, I actually don't know how they found out that we were doing this, but Richard and I were working on a little textbook about valuation, which we think is a critical skill. So I slid it across the table to Reggie and I said, look, if you guys are really serious, why don't you just give this a look and let's meet for breakfast next weekend. And, you know, I thought maybe they show up, but highly unlikely that they actually really read this book on real estate valuation, you know? And he surprised me. I mean, we were there for 3 minutes the next weekend until Reggie pulls this book out of his backpack, and it's like beat to hell. It's got lines and highlights all over it. He's like, do you mind if I ask you a couple questions? And Richard and I literally looked at each other like, I guess we're teaching this class, you know? And so it really is what launched us. And so both of those guys now asset manage big portfolios for big institutional investment managers.
Wow.
And they make multiples of what they were making back then. More importantly, they're really happy. It seems like they are. I'm really close with both of them.
That's a great success story.
Yeah, it's awesome. I mean, that makes you feel so connected to our industry. And it's not even remotely altruism. It's like kind of selfish because it's cool to be in the front row. You know, it's like buying courtside seats to a basketball.
That's a great analogy.
Yeah. But anyway, so that's why I think the long answer, but I think the passion comes from a depth of that, of like kind of getting unlucky in the beginning, but super, super lucky, you know, and then finding this industry I think is amazing that people don't talk about enough or much less provide some inroads for. And then these success stories that keep you going, you know, and you just get really close with this.
Yeah, that's powerful. So let me ask you another question. Before you even figure out real estate, like, was there a moment in your life changing schools all this time to think, you know what, like, I'm going to be different. I'm going to get out.
That's a great question. And I struggle with it a bunch because I think some kids do have that. I mean, now that I have kids, it's like, one of the craziest things about having kids is how different they are and how little control I have over them, you know, but their personalities seem so ingrained from when they get here, you know? And I definitely think I had a little bit of that was, it wasn't different, good or bad. It was certainly different, you know, and part of this is maybe TMI, but my mom, I said, she mentioned she struggled with substance abuse stuff. So I spent a ridiculous amount of time, super unhealthy for a kid to spend this much time in these environments, but in NA meetings and AA meetings, I don't know how many 5-year-olds are sitting there chatting up an addict at a meeting, you know, but it turns out that that's actually a pretty good training ground for some things. It may require, you know, a 401k worth of therapy to overcome later, but, it was a really, that is a real situation where I would talk to people and I was very, you know, curious all the time. And I don't think everybody has a curiosity, but that curiosity was rewarded a lot too, you know, because people would take note and talk with you, which was nice. So, I definitely saw that really early on, but there was a wide range of possible outcomes, you know, and I think this is true. I see this all the time, particularly when I used to teach undergrads. You'll see some kids come out shot out of a cannon, you know, and then you also see kids that aren't. And one thing that's troubling is I definitely think more of the kids that are shot out of the cannon these days happen to be females and more of the ones that don't happen to be males. I don't exactly know what's going on there, but it's enough to know that it's a solid trend. What's interesting is a lot of those guys bounce back a couple years after. They'll either get laid off, they're not making enough money that they want to make, their parents are giving them crap, or they got broken up with. Like true stories.
I believe it. Yeah.
And then they call me and they're like, hey, I wasn't really paying attention to your class, but can you talk? You know, and I know what those texts or emails are going to be about. And it's almost always that. So I don't think there's like some magic thing that, but for me, I definitely think I definitely didn't want that lot. So I was probably hyper motivated. But frankly, just absolutely and almost blindly lucked out and having so many people help,
By the way, I got to tell you a quick random stat here is that in some, I've heard from some Class A apartment developers that in some of their properties, 60% of their resident base is female.
Really? Oh, that's interesting.
And they're higher income, younger adults. Yeah. And there's, I think it reflects something you just touched on.
So this is a whole podcast series in and of itself. But my wife and I keep a list of folks, because when you know great people, you try to connect them. That list has probably 15 or 20 amazing females on it and 2 or 3 single amazing guys. And so if you want to be on the list, let me know. But it's just, there is an imbalance that, and I don't exactly know what's going on. But we see it. I see it in all the classes that I participate in. And I think a part of it is solved by just actually paying attention, and not just rewarding the people who are at the front of I think it's hard to stereotype, but a lot of times what I've seen is female students tend to be a lot more organized and front of the class types. And I know for me, I was kind of a meathead. I was a really good student, but I was like definitely a back row person, not a front row person, And I think leaning into that, not being insulted by that, and just asking someone, "Hey, what are you up to? What do you want to do?" And those little things can really light people up. So,
all right. Hey, one more question I want to ask you. Let's talk about CRE Analyst to close us out. What's the profile of a typical good candidate for the program?
That's a good question.
And tell us, you teased this earlier, but how is it different from a traditional academic program?
Yeah, I'll start with the second question, like how's it different? Because I think that's really important. So I still teach in an MBA program, master's program, and guest speak in some undergrads. I love those. I'm really proud of SMU. I help out at Texas Tech and TCU on occasion because they're all local-ish. I think those are all important funnels, but they are very different, right? So I would say that than what we work on the CRE Analyst side. And I would say that they're different in 2 big ways, kind of 2 big buckets. The first is just our approach is different. Like, we don't care about certifications. We don't care about any of that. Literally all we care about are skills. Yep. So we have a list of skills we're trying to get to. So skills are on one side, information is on the other, in my mind. Information is something you can write down on an index card and memorize. Skills are something that you actually have to practice doing. Riding a horse, swimming, shooting a basketball, hitting a baseball. Those are skills. I don't care how much you read Ted Williams, Science of Hitting. You're not gonna be a good hitter. You got to actually go and spend like dozens of hours in a cage a day almost, to be a really good hitter these days. So we're trying to get people closer to whatever hitting is like in real estate, which is negotiating contracts, reviewing a lease, valuing a property, negotiating a loan, picking a loan. Those are more like shooting a basketball and less like memorizing what is a cap rate, right? Yeah. And so every single thing that we built this class or series of classes around is around building those skills. And we don't even really call ourselves teachers because we're not. We create these environments with a teaching team of like 25 people where people can get those skills. So we break the classes in the fast track, as an example, generally in the thirds. The first third is super intense lecture. Second third is a guest speaker that makes it real. Last third of each class over the 8 weeks is hands-on practice. So we have like a real situation you got to work through in small groups under the direction of team leaders that have been through our program and do this in their day jobs. So our approach is the first big thing. It's just radically different. All of the results kind of come from that because we're just so laser focused on that, right? But then probably the more important thing is like the magnet that the types of folks that attracts are radically different, right? And especially on the margin. So said differently, who you let in is a lot different. So who you let into an academic environment is usually dictated by what was your GPA, what was your standardized test score, how much can you pay, who are your parents, who your letters of recommendation coming from. I don't care about any of that stuff. Yeah. You don't need a super high GPA. You can't be an idiot, but if you'll work hard, you can actually overcome some of that, and what we care about is if you're going to be engaged. So, and do you really know what you're getting into? Yeah. So someone on our team has an info session almost every Friday morning. And on that info session, we say, here are the stats, here's stuff, and here's what we cover. Don't take any of our classes because someone else got something good out of it. And by the way, all 20 or so of us that pitch into teaching this class, we're all working in our industry. Most of us have families. this is all of our free time. If you're getting our free time or we're investing our free time, we expect you to do the same. And if you don't want to, that's totally fine.
Yeah.
It's all good. We still want to be friends, come to happy hours, all that stuff, but you're not taking the class. And then if they say we have a pledge that everybody has to sign in the beginning, and if they say they're willing to do that and they didn't, we just throw them out. And those can lead to some tough conversations. But man, I have been so blown away by just making sure you start at the beginning in the right place and just make sure everybody's rowing in the same direction, the same pace. It just changes the game so radically. And you just can't do that in a higher ed setting. Yeah. Can you imagine if a professor said, there are 5 of you that are really badass and I'm going to throw everybody out of the class? That'd be horrible. It's not what they're there for either, right? You're there to really cast a broader net. And I could argue that some schools aren't doing that, which also makes me proud of what schools like SMU are doing. But with this, it's just totally different, so there are 4 or 5 different kinds of people that I think have found some value in what we're doing. I think we'll be able to expand that because I always am focused on higher quality and lower cost, and now it's so easy now because you kind of show up and teach. So you're able to, I'm able to generate some more content every once in a while, nights and weekends. And that's pretty awesome, and so just super focused on lowering the cost and increasing the quality. But of those 5 different kinds of people that take the class, and we'll have a college senior and a 70-year-old. Right now we have the head of research at one of the largest investment banks on Wall Street that covers CMBS in our class, and we've got a college junior, and they could be in the same group because they both know you got to run hard, and everybody in between. And so we've had tenant reps that when Randy and Craig and those guys at Stream left Cushman and moved over to Stream, I think Randy said something like, I didn't know how to value a building, so they took the class, and we just get all over the map, and we're so proud of some of the folks that have come through there, and it's cool to see them, but they're all over the map. It's just a fun magnet to be a part of. Yeah.
Well, that's awesome. Well, James, thanks so much for making time for this.
Yeah, really
enjoyed it.
Yeah. I have to say one thing before we close out too, just that I've said this to you privately, but I really mean it publicly. It was just like what you're doing is so valuable. And it's hard because I knew you before I knew you because I followed all your stuff, and then we got to know each other. And I legitimately think you're the nicest person in our industry and truly seeking the answers and not just like what your book is. People say you're always pitching your book. Our industry is awesome, but it'd be even better if there were more people like you out there. So I really meant what I said earlier. I don't know how you do it by yourself, like doing so much of putting out content, but I literally check every post. I literally read every post, and I'm not the only one. So thanks for doing that. I've listened to this podcast every time, and I really appreciate you inviting me. It's awesome.
Well, thank you, Jay. You're very kind to say that. And I certainly think the world of you. So I'm grateful for your time.
I appreciate that.
And that's a wrap for episode number 38 of The Rent Roll. Big thanks to James for visiting with us in studio and for his candor and his story and his passion. And thank you to JPI, to Waymaker, to Foxen and the Guarantors for sponsoring this episode. And thank you to all of you for spending part of your day with us. We'll see you next week.